Hey everyone, welcome back to Fintelliq. So today we are talking about something that touches literally everyone, the real estate. Whether you own a home, you are renting, you are investing, or you are just thinking about buying one day, this video is for you. We are gonna break down the entire 2026 US real estate picture: houses, apartments, office buildings, warehouses, and even the data centers. And we are gonna do it in plain simple language, no confusing, no any jargon, I promise. By the end of this video you will understand why the housing market feels so weird right now, and why some cities are booming and others are stuck, what's happening behind the scenes with big commercial buildings, and where smart money is actually putting their cash in 2026. This is pretty deep video, just about 25 minutes or even less, so grab a coffee, get comfortable, and let's get into the video. Okay, quick roadmap. So you know what's coming. We have got 7 big sections today. Now 1. The big picture, what's changed in real estate overall. 2. The housing market and why there are not enough homes. 3. Why some cities are hot and some are ice cold. 4. The huge wave of commercial loans coming due. 5. A deep dive into offices, warehouses, and even data centers. 6. What's going on with publicly traded real estate companies called REITs. And 7. At the very end, a simple game plan. Basically, if you had money to invest, where would it actually make sense to put it? Let's start from the top. So here's the big data for the whole video. I want you to really remember this one sentence. The real estate used to move all together like one big wave, and now it doesn't. Think about it like this. A few years back, if the interest rates went up or down, basically all real estates, houses, office buildings, apartments moved the same direction together. It was like a rising tide, or even lifted every boat. That's not happening anymore. All after the craziness with interest that changing, supply chains problems, and the new government policies, the market has basically broken apart into different pieces that all moving on their own. So what does that actually mean for you? It means that you can't just say real estate is good or real estate is bad anymore. You have to look piece by piece. Some parts are doing amazing. We will talk about data centers later. They are on fire. Other parts, like certain office buildings, are honestly struggling. This is actually really good news if you are smart about it, because it means there are real opportunities if you know where to look, instead of just betting on the whole market going up. That's the whole vibe of this report, and we are gonna prove it to you with the real numbers. Fine? Alright, let's talk about houses, the actual homes people live in. For the last few years, there's been a bad problem. A lot of homeowners got mortgages when interest rates are super low, like under 3.5%, and because rates went up a lot after that, none of these homeowners want to sell. Why would you sell your house and give up your 3% loan just to buy a new house with a 7% loan? You would not. So people just stayed put. That caused a huge shortage of homes for sale. But here's the update for mid 2026. Things are things are finally starting to loosen up a little bit. Let's look at the numbers real quick. The median price for an existing home right now is $398,000, and the number of homes listed for sale is actually about 10% compared to last year. So more people are finally putting their homes on the market. There are now about 964,000 single family homes for sale across the whole country, and about 3.8 months of supply. That basically means if no new homes got listed, it would take around 3.8 months to sell everything that's currently on the market. Now here's the catch: even with this improvement, we are still about 16% below the normal healthy levels we saw before in 2020. So yes, it's getting better, but we are not back to normal yet. Think of it like a patient recovering from being sick. Definitely improving, but not fully healthy yet. So now let's talk about why buying a home still feels so hard for a lot of people, especially for the first time buyers. Here's the double whammy. Home prices are still pretty high, and mortgages rates are still stuck at levels that make monthly payments expensive. So you have got expensive homes, just expensive loans at the same time. What a time bomb though. Combo for anything, anyone trying to buy their first place. Because of this, something interesting is happening. A lot of millennials and Gen Z are basically saying, you know what, I will just rent instead. And they're not just renting old apartment buildings. There's a whole new trend, what's basically called single family rentals and build to rent communities. Basically, there are entire neighborhoods of houses that are built specially to be rented, not sold. It's become a huge business, and here's the fun fact: the global PropTech industry, which is basically technology made for real estate, like apps that screen tenants automatically, smart software that sets your rent price, predictive maintenance that tells you when something about to break. Like the whole industry is now worth about $43 billion. That's massive. Landlords and big property companies are using AI now to run their buildings more efficiently, save on labor costs, and make more profit. It's a big deal, and it's only growing. Now, here's something really important. You cannot talk about the US housing market like it's one very simple thing. It's actually a bunch of totally different mini markets, and they are moving in completely opposite directions. Let's split into two groups. First, coastal gateway sites. Think places like San Francisco, New York, LA being expensive coastal sites. These markets are kind of being stuck. Prices are actually so high, and honestly, people have been stuck moving away from those cities for years now. So homes are sitting on the market a lot longer because there just is not as much as demand pushing prices up anymore. On the flip side, you have got exurban and sunbelt areas, basically the outer suburbs plus states in the southeast and southwest like the Texas, Florida, and the Carolinas, and some secondary sites in the Midwest. These places are booming because people keep moving there. More people moving in means more demand, which keeps home values solid and growing. So the lesson here is location really matters right now, way more than it is used to be. Don't just look at the national headlines, look at what's actually happening in the specific city or region you're care about. Okay, now we are switching gears to commercial real estate. That's office buildings, apartments, complexes, shopping centers, warehouses, and all that big business stuff. And there is a huge story happening right now that you need to know about. It's called refinancing wall, and the number of honestly kind of scary $875 billion. Yeah, $875 billion. Here's what that means in simple terms. A lot of big loans that were taken out on commercial building years ago, back when interest rates are super low, and now coming due this year. That's about 17% of all the commercial mortgage debt out there, out of a pool of about $5 trillion. So imagine you took a loan years ago at really cheap rate, and now the loan is due and you have to refinance it, but rates are way too high now. That's exactly what's happening to thousands of building owners across the company all at once. And to make it even trickier, banks have gotten a lot stricter. They are not lending as freely as they used to. They have tightened up what's called the loan to value ratio. Basically, how much you are willing to lend compared to what the building is worth. So, who's stepping in to fill that gap? A few players: private credit funds, non-bank lenders, mezzanine debt, and which is kind of a flexible middle layer of financing, and preferred equity and bridge loans, which are basically short-term funding to get building owners through this tight spot. This is honestly one of the biggest opportunities in the whole commercial real estate world right now, because whoever provides this financing can often negotiate really good terms for themselves. So let's talk about the offices specifically, because this is the one everybody always asks about. Is office real estate dead? The honest answer is it's completed, and it depends on which type of building we are talking about. Overall, the delinquency rate for offices, meaning building owners falling behind on their loan payments, is just sitting at about 12% nationwide. That sounds bad, and but it's not the whole story. Here, the real spirit, the Class A offices, these are really nice, modern, and well-educated, well-located, well-run buildings are actually doing fine. Companies are still renting this space because they want their employees in a nice environment. A lot of companies are pushing for people to come back into the office more. But Class B and Class C offices, these are the older kind of average, often suburban, often office buildings. Those are in real trouble. Nobody really wants this space anymore. It's outdated, it's less convenient, and a lot of these buildings are facing serious restructuring, or even getting converted into something totally different like apartments. So it's not office is dead. It's more like the good stuff is fine and the mediocre stuff is really struggling. Location and quality matter even more than ever. Now let's talk about two really important categories: the warehouses and data centers. First, industrial and logistics. This is basically all the warehouses, shipping centers, and distribution hubs where products move before they get to your door. This sector has been strong for years thanks to online shopping and companies bringing manufacturing back to the US. It's still healthy. Demand has just settled down a bit from its crazy highs and a couple of years ago, but vacancy is still low, meaning Most warehouse space is being used and rents are still going nicely. But here's the real star of the whole commercial real estate world right now, the data centers. These are the massive buildings full of servers that power the internet, cloud computing, and especially AI. Because AI is exploding right now. Everybody needs more computing power, and that means everybody needs more data center space. Demand is through the roof. But there's the interesting twist. The bottleneck is not about money anymore. Companies have plenty of capital to build these things. The real limit is power. Yes, power. Literally electricity. There's only so much power available on the grid, and getting a new data center connected to enough electricity is actually harder than raising the money to build it. That's a wild shift, and it tells you how much AI is reshaping the entire real estate world. And okay, now let's talk about something called the REITs rates, the public REITs, the leading indicator that stands for Real Estate Investment Trusts. Basically, these are publicly traded companies just like stocks that own and manage real estate. You can buy shares of them like you would buy shares of Apple or Amazon. Here's something interesting about REITs rates. I am calling that rates because they trade on the stock market every single day. Their prices react instantly to news and interest the rate changes. Meanwhile, private real estate like an individual office building somebody owns directly gets appraised way less often, and so its price gets really slowly. So when interest rates are causing problems, publicly traded REITs actually got hit and first and hardest because stock prices update in real time. But guess what? They also recovered first. As of May 2026, the big REIT index called the FTSE Nareit All Equity Index is up 14.4% this year alone. That's a really strong number, and it shows up money is flowing back into the real estate, especially the kind that pays you steady cash income, as investors rotating out of some of those really expensive tech stocks. So the next part connects is two things. We already talked about the refinancing wall and the REITs rates, and honestly this might be the most important insight in the whole video. And here's the deal. Publicly traded rates, the ones on the stock market, actually did something smart a while back. They locked in longer term debt that kept their average low, meaning they did not borrow too aggressively. They have been steadily improving their financials. Because of that, they are mostly protected from that scary $875 billion refinancing wall we talked about earlier. But private real estate deals, the ones not on the stock market, owned by private investors and syndicates, those guys are facing the wall head on. They are dealing with tighter bank lending and valuations that still need to catch up to reality. So you have got this wide gap. Public REITs rates are in pretty good shape and already recovering, while private deals are still working through their problems. For investors who want liquid, easy to buy and sell real estate exposure, that's honestly a pretty attractive window right now, because you are getting exposure to real estate without inheriting all the private market stress. Let's get specific and look at the different flavors of rates, because they are definitely not all the same. The overall rate index before remember is up around 14.4% this year with an average yield, meaning the cash dividend you get of about 3.7% solid, dependable, and kind of the backbone of the group. Then you have got data center and AI infrastructure rates. These are on fire, up 19.2% this year, and though they pay a smaller yield of about 2.8% because most of the money is going into growth instead of dividends. Given everything we said about AI demand and power constraints, it makes total sense these are leading back the pack. Next, residential mortgage rates REITs as above. These are companies that don't own actual homes, they own the mortgages like the loans themselves. They are only up 0.9% this year, but they pay a really juicy yield of 12.8%. So this is more an income play, steady cash flow, but not much price goal, and it comes with some rate sensitivity risk. And finally, commercial mortgage credit rates. These are actual companies holding loans on commercial buildings. They are actually down 3.3% this year, even though they pay a high yield of 10.5%. Why the pain? Because of these are the ones most directly exposed to that refinancing wall. We have been talking all about all the video. This is the one category the report says to be cautious with right now. And now let's zoom out and compare our three big buckets side by side. And nice and simple. Residential real estate. Actual homes is your steady inflation protected option. Home values tend to hold up well over time because there's a genuine housing shortage nationally. The trade-off is you have got to deal with local taxes, regulations, and managing properties if you own several. Commercial real estate, office, industrial, distressed deals. This is where the bigger opportunities and bigger returns can live, especially with all that refinancing chaos creating discontinued deals. But it needs more expertise, more patience, and your money is locked up for a long time, so it's not for everybody. And here's the next public REITs, the public REITs. This is your easy button. You get instant liquidity, meaning you can buy or sell today if you want. Everything is regulated and transparent. Professional managers run it for you, and you don't have to deal with a single tenant or single leaky roof yourself. Plus, like we said, they are currently priced with strong momentum as things keep recovering. So really, it comes down to what you personally want: stability, big upside with patience to ace and liquidity. So if you are building a real thoughtful real estate portfolio today, what should you actually be watching? The report points to three things to check before putting money anywhere. First, interest coverage ratios. Basically, the property owner comfortably pay your loan interest with the income the property brings in. If that number tights, that's a red flag. Second, regional demographic stability. Is this a place where people are actually moving to or moving away from? Remember our Sunbelt versus coastal cities conversation. This matters a ton. Third, lease roll schedules. This is really for commercial buildings, and it just means when do the current tenants' leases expire, and is there a plan for what happens next? And here's the actual recommendation from this report. A really solid, balanced approach right now is combining liquid infrastructure, the REIT as so called, like those data centers and logistic rates we talked about, together with direct residential real estate is going ex-urban areas. That combo gives you steady income plus real growth potential without being everything on just one type of asset. Okay, let's get very practical here, really. So if you are thinking like a bigger investor, here's basically the full game plan broken into three buckets from the safest to the riskiest. Bucket 1, exurban single family homes and built to rent communities. This is where it's conservative to modern REITs options. You could do this by directly buying real rental properties yourself or partnering with property management companies that use all that PropTech we talked about. Time horizon here is longer. Think of 5 to 7 years, again, since real estate takes time to really pay off. Bucket 2, distressed credit and mezzanine debt. This is the more opportunities, higher risk, higher reward pay, where you are basically stepping in to provide financing during that refinancing wall crunch. This usually happens through private credit funds, shorter time horizon around 3 to 5 years, because these deals tend to resolve faster. The bucket 3 here, specialized infrastructure REITs, REITs. This is where defensive liquid option, think data centers, logistics, warehouses, and grocery anchored shopping centers, which tend to be pretty recession resistant. Since people always need groceries, you can just buy this directly on the stock market, and the time horizon is short to medium, since you can sell whenever you want. So basically, steady homes for the long game, opportunistic lending for bigger short-term gains, and liquid rates to stay flexible. That's a full playbook. Of course. Alright, let's bring it all together. If you remember nothing else from the video, remember these 5 things. 1. Real estate doesn't move as one big wave anymore. It's broken into different places, so you have got to pick your spots carefully instead of betting on the whole market. 2. The housing shortage is easing a little, but it's still tough, and that's pushing more people toward renting, especially young buyers. 3. There's a $875 billion wave of commercial loans coming due, and that's creating real opportunities for anyone who can step in with financing. 4. Data centers are the hottest property type right now, and interestingly, the real limit is not money, it's electricity and power access. 5. Publicly traded rates got hit early, recovered faster, and are currently in better shape than a lot of private real estate deals. That's basically the entire 2026 real estate story in just 5 sentences. And that's a wrap, guys. Thank you for so much for sticking around this deep dive. I know it was a lot of information, but hopefully now you have got a really clear, simple picture of what's actually going on in the real estate in 2026 and where this smart money is paying attention. Quick disclaimer before you go. Everything in this video is based on research and public data, and it's meant for educational purposes only. This is not personal finance advice, so please check with an actual advisor before making any big investment decisions. Real estate can be risky and your money can be tied up for a long time, so always do your own research. If this video helped you to understand the market better, do me a favor and hit that subscribe button, drop a like and let me know in the comments which part of the country are you watching right now, coastal city or Sunbelt shirt. Thanks for watching this video and I will see you in the next one. Till then, bye.